Warren Buffett, CEO of Berkshire Hathaway, is one of the greatest investors and business persons. With an estimated net worth of $60 million, he is consistently ranked as one of the most successful and wealthiest people. So, what is his advice for those looking to invest? Check out this video that dissects his top tips. Let us know what you think. Number 1. A hardcore, ever-living portfolio. Some have criticized Warren Buffett for not investing more aggressively with Berkshire's vast cash reserves, which the company is known for keeping on its balance sheet. However, he emphasized the need to have enough cash to assure the company's survival, particularly during market panics, like the financial crisis between 2007 and 2009. It's safe to say that Buffett's company will always have a large amount of cash. It's happened before, and it's going to happen in the future. If you don't have it, you won't be able to play the next day, he says. This is like breathing fresh air, he said. If it disappears for a few minutes, everything is over. Apply the same thinking to your portfolio. Don't engage in margin trading or other strategies that could put you at a risk of a long-term loss if the market goes down. An emergency fund might help you weather the inevitable setbacks in your personal life. Number 2. Value, value, value. For this reason, Buffett cautioned shareholders against trying to time the market, as he believes it is an ineffective investment approach. Those investors who believe that they can time the market perfectly are doomed from the start. Mr. Buffett confessed, "We haven't been good at timing. As a rule, we've been rather successful in determining when we've received value for our money." Buffett remarked in March of 2020 that he completely missed the opportunity since they deployed funds too early after the 2008 financial crisis. It's important to focus on the investment's value, or how much you're paying concerning what it will produce, rather than whether or not you expect the price to rise or fall immediately when making your investments. Number 3. Prioritize productive assets on any day. When it comes to investing, investors have a wide range of options. Buffett reiterated his preference for assets that increase the worth of their owners for the third time in as many days. Stocks, bonds, real estate, farming, and a host of other assets come under this group. Investors and the media have become increasingly interested in cryptocurrency recently, but Buffett has made it clear that he is not one of them. "Because I have no idea what I'd do with it, I wouldn't accept $25 for all of the Bitcoin in the world." Buffett argued that although owning an apartment building or farmland generates rental money and food for your family, owning cryptocurrencies like Bitcoin do not. He added that a productive asset doesn't rely on the next buyer paying you more than the last buyer did. Number 4. Stay away from crypto as much as you can. Bitcoin and cryptocurrencies haven't changed Buffett or Munger's minds since they initially started warning investors about the hazards that they pose. Bitcoin is a miracle, but this year's gathering saw the 98-year-old Munger take it a step further. Trying to avoid things that are dumb, evil, and make me appear awful concerning someone else is something that Munger tries to avoid in his life. Bitcoin does all three, he says. Bitcoin is dumb because it's extremely likely to go to zero, and evil because it weakens the Federal Reserve and the national currency system, according to Munger, a well-known ideologue. Last but not least, he argued that China's decision to ban Bitcoin outright last year does not reflect well on the United States. A friendly counsel may offer you to invest your whole retirement fund in Bitcoin, but Munger advises saying no to the suggestion. Number 5. Keep away from the stock market's volatile tendency. According to Buffett, a blend of legitimate investing activity and casino-like speculation has always been present in the stock market, but the recent years have been more speculative. He told shareholders it's a gaming parlor and said Wall Street had contributed to the casino mindset. Nobody gets paid until someone does something. They make far more money when people gamble than when individuals put their money in the bank. It's practically a craze of speculating that we now have, stated Munger. Stockbrokers who know even less about stocks are advising clients who know nothing about stocks. It's a good idea to look at your financial situation to determine whether you're more of an investor or a gambler. Your trading activity may benefit someone other than yourself if you are a frequent buyer or seller of positions in the market. Another alternative is investing in an S&P 500 index fund, which Buffett has suggested in the past as a way to save money. Investing in this way can give you a broad portfolio of American businesses at a low cost. Number 6. Inflation cannot rob you of talents. Shareholders were concerned about losing buying power as inflation rose to its highest level in 40 years. As Warren Buffett put it, The best thing you can do is be really brilliant at something. What you've got can't be squandered away. It can't even be puffed away from you. Even if your salary, or the amount you get, may alter over time due to inflation, people will always be prepared to trade the portion of their output for your services. He remarked that the best investment that you can make is your own growth. Number 7. Invest in businesses with low capital requirements that have a strong potential to succeed. For a long time, Warren Buffett has argued in favor of investing in companies with high rates of return on the cash put in them. Low capital requirement enterprises should do better during inflammatory times than those that must invest more money at ever higher prices to preserve their current position. Inflation, according to Buffett, is like going up and down an escalator. Number 8. In times of rising inflation, look for companies that can raise their pricing. Warren Buffett told the Financial Crisis Inquiry Commission in 2010 that pricing power is the most critical decision in appraising a company. You can raise prices without losing customers to your competitors, since you have a solid business model in place. During periods of high inflation, businesses with the ability to raise their prices have a significant advantage, since they can offset rising costs. Having built the bridge and been able to raise prices to combat inflation, Buffett famously claimed that an unregulated toll bridge would be the perfect asset to hold in an inflationary world. As long as you use old money when you build the bridge, there's no need for it to be continually replaced. Number 9. Spend time and money on yourself to improve your skills and become the best in the field. Buffett advised shareholders in 2004 that one of the best ways to keep your purchasing power over time was to invest in your talent. The top physician or lawyer in a city or town can market their services in current dollars without re-educating themselves because their education was paid for in old money. Consider acquiring a new skill online or at a local college to add to your resume. There are certain drawbacks to getting a master's degree, such as the cost, but it can also help you to become a more valuable employee in the future. Over time, increasing your worth to your employer and its clients will help you receive a fair portion of your company's profits. Number 10. Control your desires. Charlie Munger, Berkshire Hathaway's vice chairman and Buffett's business partner, has a different strategy for dealing with rising inflation. In 2004, Munger addressed Berkshire's stakeholders. One of the great defenses to being worried about inflation is not having a lot of stupid desires in your life. This means that you have excellent protection against the ups and downs of life, as long as you haven't created too much artificial need to drown yourself in commercial products. Consider using budgeting software to help you keep track of your costs. This will give you a better idea of where your money is going and may help you avoid impulsive spending. So, what can we gather from that? If you want to be rich, you have to be willing to work hard. You keep an eye on the value of a business and then seize it when it presents itself. But don't beat yourself up if the going gets tough sometimes. Above all else, remember that you're investing in people, in hopes that they get better at their jobs and improve your chances to enjoy the true payoff: getting rich.